Good day everyone. I will discuss with my group the operating and financial leverage. In this lesson, the learning outcomes are as follows. Explain the concept of financial leverage. Discuss the alternative measure of financial leverage. Understand the risk and return implication of financial leverage. Analyze and combine the effect of operating and financial leverage, and highlight the difference between operating risk and financial risk. The term leverage refers to an increased means of accomplishing some purpose. Leverage is used to lifting heavy objects which may not be otherwise possible. In the financial point of view, leverage refers to furnish the ability to use fixed cost asset or funds to increase the return to its shareholders. James Horn has defined leverage as the employment of an asset and fund for which the firm pays a fixed cost of fixed return. Leverage can be classified into three major headings according to the nature of financial mix of the company. So what are the types of leverage? First, the operating leverage. Operating leverage is associated with investment activities. It is caused due to the fixed operating expenses in the company. Operating leverage may be defined as the company's ability to use fixed operating costs to magnify the effect of changes in sales on its earnings before interest and taxes. Operating leverage consists of two important costs, the fixed cost and the variable cost. When the company is said to have a high degree of operating leverage, if it employs a great amount of fixed cost and smaller amount of variable cost. Of degree of operating leverage depends upon the amount of various cost structures. Operating leverage can be determined with the help of break-even analysis. Financial leverage. It is present the relationship between the company's earning before interest and taxes or operating profit and earning available to equity shareholders. Financial leverage is defined as the ability of firm. So you used fixed financial charges to magnify the effects of the charges in EV or IP on the earning per shares. It involves the use of funds obtained at the fixed cost in the hope of increasing the return to the shareholders. The use of long-term fixed interest-bearing debt and preference share capital along with the share capital is called financial leverage or trading on equity.
Good day everyone. My name is Charis Jane Aileo Cario and my topic is the two primary advantages of financial leverage and how financial leverage is measured. Yung first advantage ng financial leverage is enhanced earnings. So, it allow an entity to earn a disproportionate amount on its asset. So, for example, mangungutang ako sa bangko para pang-down ko sa bibilhin kong apartment or bibilhin kong condo. So, kailangan ko ng at least 20% down payment para pwede ko nang mabili yung apartment ko. So, let's say na nagbayad ako ng loan ko sa bangko for 15K pero yung ginawa ko sa apartment ko is pinaupahan ko siya for 30,000. So, ang mangyayari, nababayaran na yung rental income or yung rental income, yun yung loan ko. And at the same time, nakakaipon ako or kumikita ako ng 15,000 per month. So, yung 20% lang yung total amount na nilabas ko, pero yung babalik sa'yo is 50% na income. And next is favorable tax treatment. In many tax jurisdictions, interest expense is tax deductible, which reduces its net cost to the borrower. However, the financial leverage is also represents the possibility of disproportionate losses, since the related amount of interest expense may overwhelm the borrower if it's not earned sufficient return to offset the interest expense. So, this particular problem, when interest rate rise on the return from asset decline, the unusual large swing in profit caused by the large amount of leverage increase the volatility of a company's stock price. And this can be a problem when accounting for stock option issued to employees, since highly stocks are considered to be more valuable and so create a higher compensation expense that will less our shares. Next is how financial leverage is measured. It is measured by the debt to equity ratio, which is used to determine the amount of financial leverage of an entity, and it shows the proportion of debt to the company's equity. And it helps the company management, lenders, shareholders, and other stakeholders understand the level of risk in the company's capital structure. And it shows the likelihood of the borrowing entity facing the difficulties in meeting its debt obligation, or its level of leverage are at healthy levels. So, the debt equity ratio is calculated in total debt. In this case, refers the company current liabilities and the long-term liabilities.
Good morning. This is Insurance R. Agkawili. My report is Risk of Financial Leverage. Financial leverage is a borrowed capital of a company or a business in order to buy more assets or in order to undertake an investment or a project. Then, what happens when financial leverage increases? So, increased amount of financial leverage may result in large swings to a company profits. As a result, the company experiences volatility of stock prices. Volatility means liability to change rapidly and unpredictable. Then, increased stock prices will mean that the company will pay higher interest to the shareholders. We all know that a shareholder is a person that has invested money in your company in exchange for a share of the ownership. Then, next risk of financial leverage is a reduced access to the more debt. For a company with a high debt to equity ratio, lenders are less likely to advance additional funds since there is a higher risk of default. However, if the lenders agree to advance funds to a highly leveraged firm, it will lend out a higher interest rate that is sufficient to compensate for the higher risk of default. Default risk is the risk that a lender takes on in the chance that a borrower won't be able to make required debt payments. A higher level default leads to higher required return and in turn, a higher interest rate. Lastly, the risk of financial leverage, um, it will lead to bankruptcy. If a company may face bankruptcy due to financial leverage effect on its solvency. Solvency is a ability to pay, or ito yung mga obligation ng isang tao or ng institution na kailangan nilang bayaran. If the company borrows too much money, it will have more chances of bankruptcy. Being over-leveraged typically leads to a downward financial spiral, resulting in the need to borrow more. Kasi, ang reason behind the bankruptcy kasi, ang understanding ko, kung ikaw ay nagtatrabaho at hindi sapat yung kinikita mo at kailangan mong mangutang sa mga nagpapautang or sa mga lenders, huwag kang mangungutang ng hindi mo kayang bayaran. Kumbaga, kung ang sahod mo ay 10,000, huwag kang mangungutang ng mas mataas sa 10,000. Pwede kang mangutang ng mas mababa doon sa kikitain mo. And if ikaw ay isang business owner or ikaw ay mayroong company at yung practices na yun ay yung natutunan at hindi ka mangungutang ng mas mataas pa dun sa sasahudin mo, then hindi mo mararanasan yung risk ng financial leverage. Kasi pag mangungutang ka ng mas mataas na sasahudin mo at dadating yung due date at sisingilin ka na ng lender, mamumroblema ka kasi wala kang pagkukuhaan ng pera. Then because of that scenario, mangyayari dyan, maghahanap ka ng ibang lenders para mangutang uli at yun yung pantapal o yun yung pangbayad mo doon sa unang utang na ginawa mo. That's all, and thank you.
And now, let's go ahead and talk about operating leverage. But first of all, what is the meaning of operating leverage? It is a company's ability to use fixed operating costs to magnify the effects of changes in sales on its earnings before interest and taxes. Operating leverage consists of two important costs: fixed cost and the variable cost. Also, operating leverage is an indication of how a company's costs are structured and is used to determine the break-even point for a company. Like example, operating leverage can help companies determine their break-even point for profitability. One great example that I can give to you is a real-life example actually. And this is a popular software maker such as the Microsoft. The bulk of this company's cost structure is fixed and limited to upfront development and marketing costs. Whether it sells one copy or 10 million copies of its latest Windows software, Microsoft costs remain basically unchanged. So, once the company has sold enough copies to cover its fixed cost, every additional dollar of sales revenues drops into the bottom line. In other words, Microsoft possesses remarkably high operating leverage. So, just to conclude, operating leverage means it is a cost accounting formula that measures the degree to which a firm or project can increase operating income by increasing revenue.
The operating leverage formula is simple when you have the various factors that it includes in the formula. The formula is as follows. Operating leverage equals sales minus variable costs divided by profits, or operating leverage equals quantity multiplied by price minus variable cost per unit divided by quantity multiplied by price and minus variable cost per unit minus fixed operating cost. So, the quantity refers to the quantity of goods sold and the price refers to the price at which item was sold. The fixed operating cost refers to the costs are that are incurred regardless of whether the sales are high or low. The variable cost per unit refers to the costs associated with the production or manufacturing of each product. Example of operating leverage. Jans Software is a leading software business which mostly incur fixed costs for upfront developments and marketing. Jan fixed costs are $780,000, which goes towards developer's salary, and the cost per unit is 0.08. The company sells 300 units for $25 each. Given that the software industry is involved in the developments, marketing, and sales, it includes a range of applications from network system and operating management tools to customize software for enterprises. So, the fixed operating cost equals 300,000 multiplied by 25 minus 0.08 divided by 300,000 times 25 minus 0.08 minus 780,000 equals 7,437,000 divided by 6,657,000 equals 112% or 1.12. This means that the 10% increase in sales will yield a 12% increase profits. 10% times 11.2 equals 120%. If the company increased sales, let's say 450 units for 20 each, the new degree of operating leverage will be calculated like this. 450,000 multiplied by 20 minus 0.08 divided by 450,000 multiplied by 20 minus 0.08 minus 780,000 equals 110% or 1.10. This means that a 10% increase in sales will yield an 11% increase in profits. 10% times 11 equals 110%. But the company generates 1,527,000 more in sales revenue. 8,964,000 minus 7,437,000 equals 1,527,000. Note that costs remain unchanged, and only by lowering the price the company increase its sales revenue.
What is financial leverage? Financial leverage is a story of assets and their returns on one side, and the way the assets are financed on the other side. The concept of financial leverage can be applied to companies, investment portfolios, and even to the house you own. In this example, we look at a factory with $1 million in assets, buildings, machines, inventory, etc. These assets generate an annual net income of $100,000. The return on assets is therefore 10%. 100k in net income divided by $1 million in assets. How are these assets financed? Let's assume the assets are financed fully by equity, shareholder capital. 100k net income divided by $1 million in equity is 10% return on equity. So far so good. Equity is not the only way to finance assets. You could also go to the bank for a loan. How about financing the assets 50% with equity and 50% with debt? Debt hardly ever comes for free. Let's assume the net income drops to $80,000 due to the interest charged. Return on assets is now 8%. $80,000 net income divided by $1 million in assets, which is lower than the 10% we had before. Return on equity goes up. $80,000 in net income divided by $500,000 in equity is 16%. This is the effect of financial leverage. Return on equity was 10% when the assets were financed fully by equity, and return on equity is 16% when the assets are financed 50-50 with equity and debt. How about taking that one step further? What if we finance the assets with $200,000 in equity and $800,000 in debt? Net income drops to $68,000 and return on assets drops accordingly to 6.8%. Return on equity, however, goes up dramatically. $68,000 in net income divided by $200,000 in equity generates a return on equity of 34%. One more step. What if we finance the assets with only $100,000 in equity and a massive $900,000 in debt? Assuming you can find a bank that is willing to grant or arrange a loan with that kind of financial leverage. Net income drops to $64,000 and return on assets drops accordingly to 6.4%. Return on equity goes up dramatically. $64,000 in net income divided by $100,000 in equity generates a return on equity of 64%. Let's summarize these 4 financial leverage scenarios with the very important disclaimer that we are assuming a very linear and very stable world. In this specific example, $1 million in assets, fully financed with equity, generate 10% return on assets and 10% return on equity. The same assets, financed 50-50 between equity and debt, generate 8% return on assets and 16% return on equity. The financial leverage is 2. For every dollar of equity, there are $2 of assets. If financial leverage is 2, then ROE is 2 times ROA. When we go to 20% equity and 80% debt, ROA drops to 6.8%, while ROE jumps to 34%. The financial leverage is 5. For every dollar of equity, there are $5 of assets. If financial leverage is 5, then ROE is 5 times ROA. It looks like the higher the financial leverage, the higher the return on equity. When we go to 10% equity and 90% debt, ROA drops to 6.4% and ROE could skyrocket to 64%. The financial leverage is 10. For every dollar of equity, there are $10 of assets. If financial leverage is 10, then ROE is 10 times ROA. Why do we mention the word could in one of the previous sentences? Well, real life can be far more volatile than a nice clean example on paper. What if the $64,000 net income turns into an unexpected loss of $200,000? In a high financial leverage situation, this completely wipes out the existing equity. Either the shareholder urgently contributes more equity to the company, or the bank will take possession of the assets, which were the collateral for the loan. Financial leverage can multiply gains and wipe out equity in case of unexpected losses.
Operating leverage is the extent that net income reacts to changes in sales levels. The degree of operating leverage is a measurement of that reaction. We calculate it by dividing the contribution margin by net income. When we calculate the degree of operating leverage for each company, we see that CouchWorld has a much higher degree of leverage, meaning that net income will have a bigger reaction, good or bad, to the changes in sales. This graph shows the actual net income that each company would have based on the same sales levels. You can see that CouchWorld's net income changes more drastically. This degree of operating leverage is something that management needs to consider when making decisions.